Hello, everybody. It is good to see you.
Good to see you.
It is day 17 of real estate school for all of you adults. We are here in the French Valley Hub. It's going to be a little bit of a boring class, but it's going to be a very exciting day at our community. Okay, so we got to trudge through the mush a little bit, do the things that we don't want to do so that we can do the things that we want to do. And today is certainly no exception. We're going to go through the reading like we always do. And of course, Amy, you don't need to share these classes out because I don't necessarily need everybody to see these. But it's Tuesday, Wednesday, Thursday. It is the boring part of real estate school. Mondays and Fridays, we have a lot of fun. Yesterday was actually a double whammy. We had Nick Baldwin to start our day for the adult course. I'm going to show, that was Nick Baldwin to start the day at 9 o'clock. And then what happened was we got a surprise visit from Ricardo Acevedo. He came by the office and we got an opportunity to talk to him and interview him live. And so this class next week, we're actually just going to replay the video. I strongly suggest checking that out. It was absolutely fantastic. Both of those classes were amazing. In fact, Amy and I, in a lot of ways, are revitalizing our business and breathing some life into it today because of the fact that we had both of these classes in quick succession. What's that? The Spanish got knocked off. Let me go ahead and turn the Spanish translation back on here. Oh, hold up. One moment. Okay. I wonder if that happened when the computer went down. Yeah. Okay, here. Just a moment, everybody. I have to fix our Spanish translation live on the fly. No, you could stay in unless the whole class got ended. Okay, just hold up for just a moment. Okay, of course, this is part of teaching this class live. We get an opportunity to do all of these things on the fly. But hey, it's the boring day anyway, so we're getting an opportunity to just go ahead and okay, we're back in. Bueno. Hello. So I knocked the computer over right when I was getting ready to start the class, and I guess we lost the live feed. Let me get the Spanish started. Okay. All right. Go ahead and test your audio there, Andres. Okay, cool. We're going. Back up and running. We're back up. We knocked over the laptop. We lost our Spanish there for a moment, but we're back up on Zoom. It's okay. Today's a boring day anyway. Yesterday was super exciting to make up for that. We had Nick Baldwin in the morning. We had Ricardo Acevedo in the afternoon. It was like magical in here. It was super magical. Okay, we're going to start in day 17. We're talking chapter 55. And of course, we're reading real estate principles. This is an open book test. So, you're not going to, don't worry about retaining all this information. You're going to have access to it in your first Tuesday handbook. So day 17 is chapter 55, Uniform Resident Loan Application. Chapter 6, the FHA Insured Mortgage. Chapter 57, Carryback Financing. Chapter 58, Usury and Private Lending. Chapter 59, A Lender's Oral Promises. Chapter 60, Private Mortgage Insurance. 365 to 401 today, which means that we are, again, not going to finish the reading. And of course, like I say, and I always say, you've got that first Tuesday book already. So when it comes time for you to actually take your test, it is open book. So don't worry about it if you don't necessarily take notes today, because you can look these questions up as you're taking the test later until you mail off, of course, for your state exam. So let's go and let's jump in here, shall we? And then at 10 o'clock, we've got commission boot camp. Anything special today?
No, but tomorrow we've got Tiffany Fox coming in.
Okay, we've got dedicated credit repair coming in tomorrow, which will be fun. But we're going to jump into commission boot camp at 10 o'clock. You're welcome to join us.
It's still not working. I'm going to back out.
It's not working? Let me go ahead and...
I think it's just if I back out and come back in, it'll reset.
Okay, go ahead.
It'll be quicker.
All right, let me know when you're in. Okay, I'm gonna go and start reading then. The instructional material. Chapter 55, the Uniform Residential Loan Application and Post-Submission Activities. Here we go, the exciting stuff. Fundamentals of the Uniform Residential Loan Application. The Uniform Residential Loan Application prepared by the buyer with the assistance of their transaction agent provides the lender with the necessary information about the buyer and property which will secure the mortgage. It also gives the lender authorization to start the mortgage package process. Okay, I'm going to go ahead and bring you back in here. Spanish translation. Am I? Good night. Sorry, Zoom. You guys have really, you guys are being put through it right now on the Zoom end of things. I apologize to everybody on the Zoom class. You guys have just been watching me yak my jaw this whole time without hearing me read. You missed all of the exciting stuff, and now we're going to jump into the boring stuff. My apologies to the Zoom crowd. Okay. Generally, a mortgage is sought in a home sales transaction, which is contingent on the home buyer obtaining a mortgage to fund the purchase of the property, known as purchase assist financing. Did our Spanish interpreter then exit the meeting? Geez, Andres. However, a mortgage may also be needed for funding by an owner of vacant land to construct a dwelling, a property owner to improve or renovate a property they currently own, a property owner to refinance an existing mortgage, or a tenant on a long-term lease who has agreed to make a tenant improvement to the property they rent. Tenant improvements are often referred to as TIs, which are, that is in commercial real estate here. As implied by its title, the Uniform Residential Loan Application is intended primarily for use on mortgages secured by residential properties. However, as generic mortgage application, it is used by mortgage brokers as an application for mortgage funding, any purpose, and secured by any type of property. The Uniform Residential Loan Application contains all the information required for arranging all types of real estate mortgages. In practice, the type of property intended to be purchased by use of the mortgage funds is improved by the description of the property in the mortgage application. Components of the residential loan application. The first section of the Uniform Residential Loan Application calls for the type of mortgage sought, such as conventional, VA, or FHA insured. The buyer also indicates the total dollar amount of the mortgage requested, the anticipated interest rate, and whether it is to be fixed or adjustable, the periodic payment schedule, constant or graduated, and the amortization period, positive or negative. The property under contract to secure the mortgage is identified and its intended use used forth in Section 2. Section 2 also states the purpose to be funded by the mortgage, such as purchase assist or refinance. Also disclosed is the source of down payment funds and closing cost. Buyer information. Is everybody in Zoom really excited that I'm unmuted now? Here we go. Okay. All right, buyer information, right? That's where we're at. Information identifying the buyer, such as their name and social security number, is entered into in Section 3. Space is left to insert any co-borrower information if the income, assets, and liabilities of a co-borrower are to be considered for mortgage qualification purposes. A separate form is used to disclose to the lender the applicant assets and liabilities if the assets and liabilities result from separate property owned by a co-borrower. Okay. The buyer and co-borrower need to prepare a balance sheet if their assets and liabilities are sufficiently joined to make one combined statement viable. If not, each co-borrower is to prepare a separate asset and liability statement for individual consideration by their lender. Employment information. The buyer's and co-borrower's employment information necessary to identify the source of their income is entered in Section 4 of the Uniform Residential Loan Application. Employment information includes the employment currently held by the buyer's job title, and years spent at that specific job and within that profession. If the buyer is self-employed, they indicate this by checking the self-employed box. Next, the buyer reports their monthly income and housing expenses in Section 5. The buyer's assets and liabilities are entered into in Section 6. This discloses the buyer's net worth. The information is pertinent since the buyer's liabilities affect their ability to repay the mortgage. However, the buyer may not want to disclose their asset. Thus, a balance needs to be struck between maintaining financial privacy and disclosing enough assets to get creditworthiness clearance so the mortgage will be funded. Since the mortgage funds the acquisition of the property, the buyers enter into pricing details about the transaction in Section 7, including the cost of repairs, alterations, and improvements made to the property. Additional components to the application. The buyer and any co-borrower declares any any relevant miscellaneous creditworthiness issues in Section 8 of the mortgage application. This includes debt enforcement or debt avoidance the buyer has experienced. The buyer signs the application with any co-borrower to acknowledge the buyer to numerous conditions, some of which are the property will be occupied as represented in the application. The buyer will amend the application and resubmit it to the lender if the facts originally stated substantially change. The lender may assign the mortgage to others, though the buyer will not be able to sell the property and delegate the mortgage responsibility to another person who acquires the property, and the lender is authorized to verify all aspects to the mortgage application as represented to the buyer. Willing and able to pay. A lender evaluating a mortgage package considers a buyer's willingness and capacity to pay. To comply, borrowers applying for a consumer mortgage are evaluated by the lender for their ability to repay. Part of Regulation Z, which implements TILA. Generally, the debt-to-income ratio, DTI, for conventional mortgages, also called the debt-to-income standard, limits the buyer's monthly payment for the maximum purchase-assist mortgage, including impounds for hazard insurance premiums and property taxes, to approximately 31% of the buyer's monthly gross income, and long-term debt plus the monthly payments to approximately 41% of the buyer's gross monthly income. Lenders use the DTI ratio to evaluate the buyer's ability to make timely mortgage payments. This is referred to as a buyer mortgage capacity. The buyer's willingness to make mortgage payments is evidenced by the credit report. The credit history demonstrates to the lender whether or not the buyer has a propensity to pay, called credit worthiness. The DTIs can be adjusted depending on one or more compensating factors, such as if the buyer has ample cash reserves, a low LTV, and spent more than 5 years at the same place of employment. RESPA disclosures. The Real Estate Settlement Procedures Act, RESPA, mandates lenders active in the secondary mortgage market to disclose all mortgage-related charges on mortgage used to purchase, refinance, or improve 1 to 4 unit residential properties. For those of you that hear the dogs barking next door, we're next to a vet's office, so I don't know if you're picking up on that or not. Mortgage-related charges include origination fees, credit report fees, insurance costs, and prepaid interest. RESPA is now administered and enforced by the Consumer Financial Protection Bureau, not the U.S. Department of Housing and Urban Development. A RESPA-controlled lender provides the buyer with a loan estimate of all mortgage terms quoted by the lender within 3 business days of the lender's receipt of the buyer's mortgage application, a special information booklet published by the CFPB to help the buyer understand the nature and scope of real estate settlement costs within 3 business days after the lender's receipt of the buyer's application. A closing disclosure, which summarizes the final mortgage terms and details provided by the lender at least 3 days before the consumer closes on the mortgage, and a list of home ownership counseling organizations. Editor's note: a list of homeownership counseling organization approved by HUD can be found at the CFPB's website. If the buyer is arranging financing through a mortgage broker, the broker, not the lender, provides a copy of the special information booklet to the buyer. However, the booklet does not need to be given to the buyer if the mortgage funds the finance of an existing mortgage, a closed-in mortgage in which the lender takes a subordinate lien, a reverse mortgage, and any federally related mortgage used to fund the purchase of other than a 1 to 4 unit residential property. Also, on ARMs, adjustable rate mortgages, the lender informs the buyer not only of the interest rate, but also the index, margin, and payment and interest rate floors and caps. Property appraisal. On the lender's receipt of a mortgage application, the buyer is appraised. The property is appraised. The buyer is also appraised, but that's called creditworthiness. The appraisal determines whether the property is of sufficient value to support the amount of financing the buyer requests. Essentially, the lender uses the appraisal to gauge whether the loan-to-value ratio, or LTV, meets the lender's standards. Generally, an acceptable LTV for conventional mortgages is 80% of the property's value, requiring the buyer to make a minimum 20% down payment. A greater LTV compels the lender to require the buyer to obtain private mortgage insurance, or PMIs. Once a lender approves property based on the appraisal, a mortgage package is assembled and sent to a mortgage for review. Now, of course, there is the VA loan, there is the FHA loan. Right now we're talking about that 20% in equity and the 20% down payment because we're speaking specifically of the conventional right now. Mortgage approval. A mortgage approval issued by a lender is often conditioned on a buyer providing more information or taking corrective actions. For example, the physical condition of the property may need correction. Title may need to be cleared of defects. Derogatory entries on the buyer's credit report may need to be eliminated, or the buyer's long or short-term debt is to be reduced. Once conditions for funding are met and verified, the mortgage is classified as approved. Escrow calls for mortgage documents and funds, and on funding, the sales transaction is closed. Agents need to remind themselves that the degree of risk each lender finds acceptable is different. More often than not, a lender exists who will make a mortgage of some amount and under some conditions to nearly any buyer. It is the business of lenders to do so. Chapter 55, summary. Elfin, we are dumb. We might be dumb. I don't think we're dumb. I think we're pretty smart. Jeez, Serpa. Take the marbles out of your mouth. Chapter 56, the FHA insured home mortgage. We just talked about conventional, which is why we're talking about 20% down. Now we're talking about the FHA insured mortgage, which is a different program. It's the Fair Housing Administration. And let's go ahead and let's jump into this, shall we? Enabling tenants to become homeowners. Consider a residential tenant who is solicited by a real estate agent to buy a home. The financial and tax aspects, together with the social benefit of home ownership, are compared to the corresponding benefits and mobility provided by renting their shelter. The tenant indicates they are ready and willing to be the homeowners of a home for their shelter. However, they have not accumulated enough cash reserves for their down payment needed to qualify for a mortgage they need to fund the purchase of their home. The agent assures the tenant that first-time home buyers with little cash available for a down payment can buy a home by qualifying for a purchase assist mortgage insured by the Federal Housing Administration, or FHA. By insuring mortgages made by the less demanding cash down payment requirements and with high loan-to-value (LTV) ratios of up to 96.5%, the FHA enables prospective buyers to become homeowners. The FHA does not lend money to buyers, Rather, the FHA insures mortgages originated by approved direct endorsement lenders to qualified buyers who will occupy the property as their principal residence. For issuing insurance to the lender covering losses on a default, the buyer will pay premiums to the FHA for the coverage. To qualify for an FHA insured fixed rate mortgage, a first-time home buyer is required to make a down payment of at least 3.5% of the purchase price. The interest rate on the underlying mortgage is negotiated between the buyer and the lender. Now, that being said, just because your buyer does not have 3.5% down, that does not mean that there are not programs out there. This is talking about FHA. In fact, there are a lot of different programs out there. There are conventional 1% down programs. There are FHA first-time home buyer programs, first-time home buyer credits. There's, of course, the VA loan, which is the zero down program, which we're getting into later. But right now we're talking FHA, and the general requirement is a 3.5% down of the purchase price. Okay, buyer liability on a default. If a buyer defaults on an FHA insured mortgage, the FHA covers the lender against the loss on the entire remaining balance of the mortgage. This is unlike private mortgage insurance, PMI, and insurance from the Veterans Administration, VA, which only insures a portion of the total mortgage amount. After the lender requires the property through foreclosure and conveys the property to the FHA pays the lender the amount of the unpaid principal remaining on the mortgage. Before accepting a conveyance from the lender, the FHA requires the lender to confirm the property is in a marketable condition and has not suffered any waste. The FHA then sells the property to recoup the amount it paid to the lender. Unlike conventional home mortgages where a lender is involved, where only a lender is involved, a buyer who takes out an FHA insured mortgage with a lender is personally liable to the FHA for any loss the FHA suffers as a result of the home buyer's default. When the FHA suffers a loss, the FHA can obtain a money judgment against the home buyer for the difference between the amount of the FHA paid the lender and the price received from the sale of the property. California anti-deficiency mortgage laws do not apply to FHA insurance coverage for lender claims on insured mortgages. 1 to 4 unit mortgage default insurance. The most commonly used FHA insurance program is the owner-occupied 1 to 4 family home mortgage insurance program. Section 203B. Buyers obtaining a Section 203B mortgage needs to occupy the property as their primary residence. For the privilege of making a small down payment, the buyer needs to pay a mortgage insurance premium, MIP, to the FHA. This essentially increases the annual cost of borrowing as the annual rate charged for the MIP is added to interest payments. Together, the MIP and interest are the annual cost incurred to borrow FHA insured funds for the purchase of a home. FHA guidelines include manual underwriting for home buyers whose debt to income ratio exceeds 43% and whose credit scores are below 620, 5% down payments on FHA mortgages greater than $625,000, and MIP to continue through the life of the mortgage. Previously, it was canceled once the homeowner reached an LTV of 78%. Further, an upfront premium paid once at the time the mortgage is originated is calculated at 1.75% of the funded mortgage amount. The public policy rationale behind the FHA Section 203B program is based on the proposition homeowners are less of a financial burden on the government in their later years than lifetime tenants. FHA dollar limits by region. The maximum FHA insured mortgage available to assist a buyer in the purchase of a 1 to 4 unit residential property is determined by the type of residential property and the country in which the property is located. A list of counties and their specific mortgage ceilings is available from FHA or an FHA direct endorsement lender, or online from the Department of Housing and Urban Development, HUD, at http://www.hud.gov. Period. The FHA sets limitations on the amount of a mortgage it will insure. The limit is a ceiling set on the percentage of the appraised value of the property, called the loan-to-value ratio. The LTV ratio on an FHA insurable mortgage is capped at a ceiling of 96.5% of the property's fair market value. Thus, the minimum down payment is 3.5%. Additionally, even after including the buyer paid closing cost in the LTV calculations, the insumerable mortgage amount cannot exceed this ceiling of 96.5% of the property's appraised value. Exciting. The maximum mortgage amount of the FHA will insure is the LTV's ratio percentage amount, the lesser of the property's sales price or the appraised value of the property. Closing costs may not be used to help meet the 3.5% minimum down payment requirement. Also, closing costs are not deducted from the sales price before setting the maximum mortgage amount. The lender's origination fee included as a closing cost is limited to 1% of the mortgage amount, excluding any competitive discounts, points, and the 1.75% upfront MIP. Either the buyer or seller may pay the buyer's closing costs, called non-recurring cost. The lender may also advance closing costs on behalf of the buyer. Credit approval. For a buyer to be creditworthy for an FHA insured mortgage, the following debt-to-income ratio needs to be met. The buyer's mortgage payment may not exceed 31% of the buyer's gross effective income, called the mortgage payment ratio, and the buyer's total fixed payments may not exceed 43% of the buyer's gross effective income, called the fixed payment ratio. A buyer's income consists of salary and wages. Social Security, alimony, child support, and government assistance are factored into the buyer's income to determine effective income. The buyer's effective income before any reduction for the payment of taxes is referred to as gross effective income. The maximum mortgage payment ratio of 31% of the gross effective income determines the maximum amount of principal, interest, taxes, and insurance, fire, and MIP the buyer is able to pay on the mortgage collectively. This is called PITI. God, I want a breakfast burrito. Breakfast burritos after this. A must. Oh, commission boot camp after this. Then breakfast burritos. All right, back to work. A buyer's income. A buyer's income consists of salary, wages, Social Security. Oh, I already read that crap. The maximum mortgage payment ratio of 31% of the gross effective income determines the maximum amount of principal, interest, taxes, and insurance. I already read that crap too. I need to stop thinking about breakfast burritos, Amy Serpa.
Need some brain food.
I need some brain food. I need to start eating in the morning. Lenders use the maximum fixed payment ratio of 43% of the gross effective income. Applying this ratio, they determine whether a buyer can afford to incur the long-term debt of an FHA-insured mortgage in addition to all other long-term payments the buyer is obligated to pay. When computing the fixed payment ratio, the lender adds the buyer's total mortgage payment to all the buyer's recurring monthly obligations. This includes debts extending 10 months or more, such as the installment loans, alimony, and child support debts and child support payments. There it is. However, even if the buyer's ratio exceeds the FHA requirements, the mortgage may be approved if the buyer makes a large enough down payment, has a good credit history, has substantial cash reserves, and demonstrates potential for increased earnings due to job training or education. Taken together, these are referred to as compensating factors. So whenever a deal is falling apart, you're just like, well, what about these compensating factors? Put that one away. Put it in your back pocket. RESPA and TILA disclosures. The RESPA Act requires any lender requiring an FHA insured mortgage to deliver to the mortgage applicant a loan estimate published by the Consumer Financial Protection Bureau, CFPB, of costs paid to provide services on the sale of a 1 to 4 unit residential property. God, that sounded more interesting in Spanish in there. Lenders also deliver a Housing and Urban Development HUD information booklet. Both need to be delivered within 3 days after receiving the buyer's application. Upon a sale, the lender delivers a closing disclosure published by the CFPB detailing all mortgage-related charges incurred by the buyer and the seller. Mortgage insured by the FHA under Section 203B are subject to both disclosure requirements since they fund personal use mortgages and are federally related. Personal liability of the seller. When a home is sold with the buyer taking the title subject to an existing FHA insured mortgage under some arrangement to pay the seller's equity, the seller is released from personal liability if they request a release from personal liability, the prospective buyer of the prospect is creditworthy, the prospective buyer assumes the mortgage, and the lender releases the seller from personal liability by use of an FHA approved form. If the condition for release from a personal liability are not satisfied, the seller remains liable for any FHA loss on their insurance coverage for the next 5 years after the sale. However, if 5 years pass from the time of the property is resold, the seller is then released from personal liability if the mortgage is not in default by end of the 5-year period, the buyer assumes the mortgage with the lender, and the seller requests the release liability from the lender. So some of these FHA homes that go into default, do you wonder why they sit empty for a little while? There's a little Easter egg if you're paying attention, right? Energy efficiency. Homeowners and home buyers have a way to finance energy efficient improvements under the FHA's Energy Efficient Mortgage EEM program. The underlying idea behind the EEM program is this: reduced utility charges allow applicants to make higher monthly mortgage payments to fund the cost of the energy efficient improvements. Financeable energy efficient improvements funded under FHA's program include purchasing energy efficient appliances or heating and cooling systems, installing solar panels, installing energy efficient windows, installing wall or ceiling installation, and completing repairs of existing systems to improve energy efficiency. Under the EEM program, the cost of fundable energy improvements are added to the base of the FHA maximum mortgage amount on a purchase or refinance. Like most FHA mortgage programs, the EEM is not funded by the FHA. It is funded by a lender and insured to guarantee repayment by the FHA. An EEM may be used in connection with either an FHA insured purchase or refinance mortgage, including streamlined refinances, under the standard 203B program for 1 to 4 unit residential properties, a 203K rehabilitation program, a 234 program for condominium projects, and a 203H program for mortgages made to victims of presidentially declared disasters. Sorry, I just had an idea. I needed to write it down for later. Eligible property types include new and existing 1 to 4 unit residential properties for the 203B and 203K programs, 1 to 4 unit condominiums, and manufactured housing. What is absolutely wild is that there is this requirement here that a property sit empty for 5 years. So if it is reoccupied within 5 years, somebody does not have to repay their debt to the FHA. And then I'm looking at all these homes that are sitting empty that could be being sold, and I'm like, isn't that a pretty sneaky way out of that, right? So instead of, a lot of these banks are not releasing properties the way that they would, so they sit intentionally unoccupied. And people are like, well, why would they sit on inventory? Well, geez, why would they sit on inventory? I could think of a couple of different reasons. So here's a big reason why the banks sit on inventory. If all of the banks were to suddenly release the inventory that they sit on, it would flood the market with available housing that people can purchase, right? Which would bring the cost down a little bit for everybody, including people that currently occupy their homes as primary owners, but also including the banks. And so what the banks do with these properties is they release them little by little instead of flooding the market with them in order to try to keep housing prices going up. And you see a lot of artificial inflation, and you and I, we talk about this all the time. We talked about it with the largest increases to FHA and VA loan limits in history, flooding the market with more buyers. People could say empowering buyers, but the inverse of that is that, are they getting empowered as prices continue to go up and we're not building more homes, right? And so part of that is when FHA and VA buyers had their home limits increased, well, what also increased was their monthly payments, right? And the monthly payment becomes a difficult thing to factor when somebody says, oh, guess what? You can afford a $500,000 home. And I can tell you, I bought my house for $385,000. I bought a similar house for $235,000 in 2012 when I was in the Marine Corps. The same type of house that I'm living in now, my wife told me with a waived appraisal this morning that we could sell it for $600,000. I'm like, no wonder people are thinking about leaving California. We've artificially done this, and then what's happened is now President Biden, and I understand, the path to hell is paved with good intentions, right? But there's a first-time homebuyer credit now of $15,000, which they're talking about passing, which will probably pass, and it should pass, right? Because people can't afford to buy, but what needs to happen is we need to reevaluate the way that we're looking at home ownership versus home values, right? So the more and more people that buy their home, pay off their home, get the slip from the bank, own title to their own house, that creates stability in an economy versus selling your house for $10,000 more than your neighbor in housing scarcity, which is what we're currently seeing in California and in a lot of the big cities throughout the country. Okay, soapbox off, but I hope that I kind of explained that a little bit for why a bank might want to not release inventory or to sit on listings. Okay, under the EEM programs, the cost of fundable energy improvements are added to the base FHA maximum mortgage amount on a purchase or refinance. Like most FHA mortgage programs, the EEM is not funded by the FHA. It is funded by the lender and insured to guarantee repayment by the FHA. An EEM may be used in connection with either an FHA insured purchase or refinance mortgage, including streamlined refinances under the standard 203B program for 1 to 4 unit residential properties, 203K rehabilitation programs, 234C programs for condominium projects, and 203H programs for mortgages made to victims of presidentially declared disasters. Eligibility property types include new and existing 1 to 4 unit residential properties for the 203B and 203K programs, and 1 unit condominiums and manufactured housing. Chapter 56, Elfine, done. 381 in the books, 382 in the books. Moving on. We're flying now. Chapter 57, we're on page 383. We're reading to 401 today. Chapter 57, Carryback financing in lieu of cash. You see a lot of this right now because there is a lot of land. They do not print more land, right? A lot of people want to get into it. And hey, talk to Andres about this, right, Andres? Exactamente, right? So I'm not going to blow your idea here for you, Andres. All I can tell you is that Andres is working on something very big with this exact type of thing because there's so many opportunities in carryback financing right now in lieu of cash. There's so much land right now out there. There's so much investment opportunity if you can find the deal, right? See a need, fill a need. You become extraordinarily wealthy when you make product available to your consumer by figuring out innovative ways to do it. I appreciate that. This is Andres and I have had a lot of brainstorms about this. Andres has got a big old brain, and he's putting it to work for everybody. Seller financing supports the price. When the availability of real estate mortgages tightens, a seller hoping to locate a buyer amenable to the seller's asking price needs to consider seller financing. Seller financing is also known as an installment sell, a credit sell, carryback financing, or an owner will carry sell. Seller financing occurs when a seller carries back a note executed by the buyer to evidence a debt owed for purchase of the seller's property. The amount of the debt is the remainder of the price due after deducting the down payment and the amount of any existing or new mortgage financing, used by the buyer to pay part of the price. On closing, the rights and obligation of the real estate ownership held by the seller are then shifted to the buyer. Concurrently, the seller carries back a note and trust deed, taking on the rights and obligations of a secured creditor. Marketing the property the seller will carry. So of course you're going to get more offers, and I'm just going to kind of go over this a little bit because there's a lot of good things that we're covering today, and I don't want to get too caught up in the woods. Marketing that a property that your seller will carry. It's basically saying your seller is willing to accept a portion down, et cetera, so forth, in order to wait for the full amount of payment later. Sometimes this is an extended period of time. Sometimes it is a quick period of time. Flexible sales terms for the buyer. So what this means, so moderate down payment. So maybe they will have you pay 10% down on land. So 10% of $100,000 is $10,000. That's not that bad. You could find land for $20,000, for $15,000, and then 10% of that is $1,500, right? Or $2,000, right? And a lot of these are hard to sell right now. So giving them a little bit, it's competitive interest rates, right? They may not charge you as much as a bank would for this same type of loan. Less stringent terms for qualifications and documentation than imposed by lenders, and no origination hassle costs. In a lot of ways, this whole seller back thing is sort of like a handshake kind of a deal, a kind of an old school way of doing things that I love it. I love it. Price to interest rate trade-off often takes place in the carryback environment. We get tax benefits and flexible sales terms. Again, we're not going to get into this. We are not tax consultants. I would rather continue to read more later. But the thing is it's also beneficial for the seller, not just the buyer, to hold on to the property for a little while. A lot of times while the property continues to become worth more. So if you carry back and you have someone buy a house for 5 years down the road, that property is now going to be worth more 5 years later. And if you put in an escalation clause, you've protected the seller, and the buyer is now willing to pay more for the adjusted value of the property. Closing documents needed for the carryback: land sale contracts, lease option sales, sell leasebacks, trust deed notes, standard all-inclusive. Easy stuff. Promissory notes, trust deed lien on the property. The county recorder, of course, gets involved. This is the foreclosure cost sheet. Carryback risk for the seller. Now here is the risk. Somebody buys your house. They give you $2,000 down or $10,000 for your land. They get a mobile company to lend. They go in, they set up city water, city power. They improve your land, and then they stop paying you. Or they lose their job or whatever. Now, you better hope that they did a good job because you still own the land, right? Now, there's a lot of different ways that you can do this. Like, you can have it so that the seller can be paid off. Anyway, lots of different things that we could get into, and we could get into that later. But there are risks associated with that, especially once the land starts getting improved. Okay. So a lot of times a carryback is good to go ahead and get a transaction started, but not necessarily a good way to see it through all the way to completion and development of a property. Chapter 58, usury and the private lender. Again, this is one of those things we're not going to get too often in the woods. I'd rather talk about the VA loan. Is that the next chapter? Let me check really quick. I need to remember what we got going. Private mortgage insurance, usually a lender's oral promises. Okay, so you know what? Let's get into PMIs because realistically, we're only going to have enough time for one more chapter today. And I don't want to, lenders' oral promises are good too. Because I could take some lenders to the freaking bank right now for some of their promises that they've said. Little sick of all these lenders saying that they're going to do things that they're not going to do or that they're incapable of doing. That's okay though. Okay, so let's get into the oral promises because that's important. Chapter 59, a lender's oral promises as commitments. I appreciate the Spanish translation and the passion coming from the other room. No responsibility for oral or conditional promises. What does this mean? This means that they're talking out of their butt cheeks and that we need to show up in their parking lot with a bat sometimes. No, I'm just kidding. No, so really quick, escape from an oral commitment, the Truth in Lending Act. There's a lot of different things that people can do to sort of protect their heinies, right? But at the end of the day, here's the truth, and I'm going to break it down for you, Barney style. Instead of getting off into the woods with a bunch of bull crap, let's talk about instead of the book way, the way that it should be done, okay? Work with a lender that you know where their office is. Work with a lender who is a member of your community. Because I could tell you what, if you work with a lender who's in Texas and they hang up on you, what are you going to do? What are you going to do? Okay? If you work with a lender, they say, oh, I don't know. Maybe you should, figure it out. People don't talk to people like that when they can find them easily. So at the beginning of my career, the way that I would close all of these escrows is, and I tell people all the time, you don't get paid to open escrows, you get paid to close escrows. And so I would literally get in my car when I was having an issue with the lender, and I would show up at their office. And they say, oh, such and such isn't here right now. Okay, good. I've got nothing but time. I'll wait. I'll wait for the lender. Oh, well, they told you that, they hadn't heard back from the underwriter yet. That's okay. I've got nothing but time. I know the underwriter's a person. They keep a schedule. They've got a home. They've got an office. Where are they right now, right? So at the end of the day, you don't get paid by hearing no for your clients and accepting that as an option, right? If the mission is critical, what is the mission, right? And if the mission is homeownership and your clients have trusted you with that, then figure it out. So I can tell you right now, I will never work with a lender again that is an out-of-state lender to represent my buyers. Not again. Not a single time. Get back to community, right? It's time to get back to community. You got a lender that you can't show up at their house and be like, hey man, I don't appreciate the way that you talk to me. Then what ends up happening is you get a lot of soft-handed lenders that don't know how to knuckle up for their clients. That's why they're all spending time in the Bahamas, right? Spending time on cruise ships because they forgot how to work. A bunch of bosses, man. We don't need bosses. We need leadership. All right, private mortgage insurance, PMIs. All right, 397. Look at that. We finished our reading today. It's like skipping some bull crap. Protecting the lender from loss. Private mortgage insurance. Indemnifies a lender against losses on a mortgage when a borrower defaults. The lender's recoverable losses include principal on the debt, any deficiency in the value of the secured property, and foreclosure costs. PMI insurers are unrelated to government-created insurance agencies such as the Federal Housing Administration and the Veterans Administration, which also insure or guarantee mortgages made to qualified borrowers. PMI is not mortgage life insurance, which pays off the insured mortgage in the event a borrower dies, becomes disabled, or loses their health or income. The bank is coming to kick you out if you suffer at all. There's the 5-minute warning. I think that was a little bit more of a fun class today. Shots fired. Bang, 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 bang. Okay. Hey, I'll tell you what. You guys got 3 pages to read on your own. It is really not that big of a deal. In fact, you don't even have to read them. Like I said, it's an open book test for a reason. Am I right, bro, or am I right? You're going to knock out those 3 certificates. You're going to get them mailed in, figure out all of that good stuff. Hey, Zoom, if you have any questions, now is the time to go ahead and put them in there. I'm going to start wrapping up. New homes are being auctioned off as well, with all the homes being sold well over asking. New builders are wanting to get top dollar too. That's a great point. It used to be that you could show up, and I've never been a fan of new home builders. In fact, I had a new home builder, no offense, and I'm not going to say the company, should come up to me and say, hey, do you have a preferred working relationship with this new home builder? And I said, no, because they screwed me over out of a commission in the first year of my real estate career, and I have never shown a new home since, because I tell people it's like walking onto a car lot. Nobody there cares about you. They don't care about your freaking vested interest. And if you do, you found a diamond in the rough. You found the exception. You found the anomaly. You didn't find the rule. Okay, and of course, we all know what happens when you buy a new car and you drive it off the lot. Depreciates, right? Okay, so I'm not a big fan of new home builds, especially the way that they are structured currently. Today was day 17. We got a little off out in the woods at one point or another because, we have to get off in the woods every once in a while. We talked chapter 55 to 60. We covered 365 to 398. So you got about 3 pages of homework. And then we're going to start commission boot camp in just a couple of minutes, or at least Amy is, and I'm going to get a breakfast burrito. California. With French fries in it. California. California lovin'. French fries and hot sauce. California lovin'. We're drinking horchatas. Okay, see you later.